Change out speakers just a minute, and Chris Jeffers, who's one of our directors in the wealth management group, is going to step up and talk through some of the different insurance, retirements, and other areas.
Good morning. So many of you probably own life insurance, disability, or long-term care, and after you buy the policy, you think, well, I'll just put it in a file, and if I die, we'll look at it, or if I become disabled, we'll look at it. So there's a lot of moving parts to life insurance and these other insurance products. So for life insurance, many of you may own term insurance that has a fixed or a guaranteed level term period of 10, 15, 20 years. As you approach the end of that period, you have some options. You can either buy a new policy, let it fizzle out, or if your health has changed, you become uninsurable, or you would only qualify for a very high premium, and you want to keep the coverage. Many people don't know that you can convert all or part of that company's term policy into one of their permanent policies without evidence of insurability and keep the same rate class. So if you have one of those types of policies, look when you purchased it and confirm how many years are left on that. With disability, there's some different things to take into consideration. What the elimination period is and how long of a benefit you'd like to have that apply for. And so if your income is increased or your cash flow is much better, you've had more saving, you could always increase the elimination period, which would thus drive down the cost of the insurance. And then with long-term care, same thing. They have elimination period and benefit periods. If you own a disability policy that you've purchased on your own, many times they have a future income increase option. So if your income has risen, every so often they will allow you to increase the benefit of that. So you may get a letter, or you need to speak to your advisor who you purchased that policy through. And then review beneficiary designations. Many times if you become divorced or you get married, that's a great time to review the beneficiaries, not only on your life insurance, but your retirement accounts. There's a lot of horror stories out there where someone had their wife on their beneficiary for their life insurance and their IRA, and they get remarried and they don't change it, and there's a big windfall for that ex-spouse. I've also seen many times people who don't have children or married, and they'll put their estate as the beneficiary of a life insurance policy or a retirement account, and thus after you get married or have children, maybe that's not the correct way to do that. So checking beneficiary designations is a really important thing to do each year. And then reviewing your homeowners policies, shopping for competitive rates, so maybe consider consolidating your insurance with one carrier. If you've gotten married, one spouse may have theirs with State Farm and one with another. Consider consolidating that to save a little bit of money. And then one of the important things that we stress in a financial planning relationship is getting together at least once a year. Most people spend more time planning their family vacation than they do on their financial planning, and it's just difficult for an advisor to communicate any changes in the markets and products and services, and trying to find out what's going on in your life via email or the phone. So a face-to-face meeting gives us a chance to identify if there's been any changes in your life or your business or any of your financials. So if you've had children, you've bought a bigger home, you've started a business, maybe you have some business partners, maybe you need to change your insurance to make sure it's growing with you, whether that's purchasing additional insurance on yourself, your family, a key employee at your business, or if you have partners in your business, funding your buy-sell agreement with life insurance. Any questions about that? No? Okay. Health insurance. So many companies offer flexible spending accounts and health savings accounts, or many times you can go out on your own and open a health savings account. They both allow you to put monies into those on a pre-tax basis. The health savings accounts allows you to put in about $33.50 per person, $66.50 as a family, and those monies can continue to grow. You're not required to take those out at the end of the year. And some of them also offer investment choices. So it's a great way to add a little money to something on a pre-tax basis when you're doing your taxes. If you've already max funded your retirement plans in an IRA, there's another avenue to put some money away on a pre-tax basis. The flexible spending account you have to flush the money out at the end of each year. So it's not as flexible as the health savings account. We're into the season of updating Medicare or registering for Medicare when you reach age 65. And then at the end of the year, if you've paid your major deductibles and your insurance and you have surgery or something you want to consider, now would be a good time to do that. I'm not recommending just going out and having surgery, but if you have something on your list there. Estate planning, Greg. Gifting, you're allowed to give $14,000 per person per year, $28,000 as a couple. Always a good time to update your wills, your trusts, directives to physicians, guardianships for minors. You have the ability to gift highly appreciated assets. Nancy mentioned stock, but you could also do other types of assets for gifting purposes. Each individual has a gift tax exemption of $5.43 million. That number has increased over the years. A lot of people think, well, wow, that's a huge number, but that does take into consideration at your death the life insurance that you own, your business, your home, and any assets. So that number, we see many people getting up to that fairly quickly, especially when you take into consideration the life insurance benefit that comes into the estate at your death. And then consider paying for family, children's medical, and education bills directly to the institution versus giving them the money for that. Make sense?
One thing that we were talking about yesterday too, just for everybody on the lifetime gift tax exemption, with all the boomers that are aging and the amount of wealth that's going to be transferred, I saw a number recently by JP Morgan or somebody that they've now upped it to $10 trillion. It's going to be moving around and flowing through the system. We really believe, and Nancy and Chris and I were talking about this, that this may be a way that the government goes back and they whack that number, and that'll be a way they can pick up a lot of additional tax dollars just by reducing that. And so if you've already used it, it's gone. They can't change it. And so it's one of the things we're encouraging people, especially with their parents and stuff, to look at is utilizing that ahead of time so that you use it before it potentially goes away. If with the big deficits we're running, and if we ever get in a position where the government needs money, that's a great way. It's easy to take tax dollars from you when you're dead.
So can I?
Yeah.
Remember, there's a lot of confusion. That number, it says gift exemption. Remember that the gift and the credit at your death are the same thing. It's not two different. I've had people think that you get that as a gift while you're alive and then you get it when you die. But it's all the same thing. So it's just, it's one. You can either use it to gift while you're alive or as your death exemption. So it's all one number. So that's why Greg is saying you can use it now to gift as part of your estate plan, but then you won't have the exemption when you die.
Right.
So so using it now is a great benefit in case it changes.
Question?
You mentioned that life insurance payouts kind of against that. Now, is that if the life insurance names the estate as a beneficiary, or if the life insurance goes to a named beneficiary, isn't that outside the estate?
So, for example, if your spouse is the beneficiary of your policy,
Right.
So the state taxes are due at the second death if you're married. So that insurance monies would go to the spouse, and then at that death, those are included in the estate.
Okay,
Yeah. So one way you can avoid that is have the life insurance in an irrevocable life insurance trust. And so if you have an existing policy and you put it into an irrevocable trust, there's a 3-year look back. So, yeah. Then here's some retirement ages when you need to consider. At age 50, you're able to play catch up in your 401k and IRA accounts. The current maximum contribution you can make to a 401k is $18,000, but after you pass 50, you can add another $6,000 to your 401k. And then to IRAs, the maximum you can contribute is $5,500, but after you pass 50, you can contribute an additional $1,000. At age 55, if you are retired, you can actually take monies out of your qualified plans without the 10% penalty. And at 59 and a half, that's when you can take the monies out without the penalty, but you always pay income taxes. And then from 62 to 70, that's when you qualify to start taking your Social Security. 65, as I mentioned, you can apply for Medicare. And at 70 and a half, you have to start taking required minimum distributions from your IRAs. There's a calculation based upon your age. You have to take a minimum amount out of your IRAs each year. A lot of people aren't aware of that. It can be delayed if you're still participating in a 401k. You don't have to take distributions from the 401k, but you do from the IRAs if you're still employed. And then 529 plan contributions, which is a tool that many people use to save for their children's education. There's that gifting number of $14,000 that you can contribute, or you can front load a child's or a grandchild's education plan by putting 5 years worth of those gifting dollars in up front.
And that number is actually 70,000, not 75.
Yep. And then review your Social Security claiming strategies if you're nearing or in retirement and haven't taken your Social Security yet. There are multiple websites, and advisors have optimizing tools to look at the different strategies that are available. And you can get your Social Security statements online. There's a Social Security website. I don't believe they're mailing those out anymore. And it'll show you what your benefits are at those different ages. And so if you take it early, you receive a smaller benefit, and the longer you wait, that benefit increases.
I have one quick question.
Yeah.
The definition of retired, if you retire from active employment and start a consulting business with respect to delaying the required minimum distribution,
You're still working.
even though you're working for yourself.
Yeah. Okay.
Good.
I have a question.
Yes?
If you put 70,000 into a 529 plan, is that out of your estate?
Does it come out?
Yeah.
Yes.
Because it's in a trust, it's in a trust. So it's out of your estate.
Good.
So anytime you have personal issues or changes, you need to talk to your advisors. And a lot of times, some of these are not that horrible, but like when you move, we need to notify the IRS. And you probably need to update it with your attorney, or there may need to be insurance company policies that need to be updated. So all of these things are fairly significant, and they will cause some changes. And sometimes you don't want to deal with them, or you don't know what repercussions they cause. But you need to, and you need to talk to your advisors. Again, we may need to change beneficiaries like Chris talked about, or we may need to do some tax planning, or we may need to change your will, or estate planning, or there's just a myriad of things that we may need to deal with. So changing jobs, it may be as simple as changing your withholding or making estimated tax payments. But there's so much that's involved in today's world as we make changes. So we want to encourage you to add that to your planning and to let us know. Okay? So I think we're going to move on to the corporate. But before we do that, I want to draw attention to that there's some supplementary information that we've added, that we've given to you, and it will give you some of the personal income tax rates. There's some retirement, all the retirement, some of the Chris went through, so it gives you all of the maximums, and So I think you'll find some of that supplementary information as stuff that we went through really quickly, and it'll help you.